Hello traders, welcome to FreeFX. Today is Friday the 20th of November 2015. The topic of the day is going to be risk trends. So in the video today I'd like to cover what risk trends are and what risk trends are at the end of 2015 and at the end of this trading week in terms of going forward towards the end of the year. When we talk about risk trends, we want to concentrate on different areas of the market. And this is one of the reasons why I'm going to talk about three particular assets. So the first one is the currency pair euro pound. The second one is the currency pair pound Kiwi. And the third one is the Footsie 100. So let's talk about the European situation and risk trends with regard to the euro. So looking at the euro pound, we can see that we have this technical formation, and it's very easy to see where it's heading. Okay, we have certainly a formation that has been consolidating from 2009, beginning of 2009, and we're down at the bottom of this trend channel or support line, if you like. So we are testing this several times, and if you compare this to the 2010 test or the 2012 test, you can see how much more stubborn this pressure on the trend line is, almost to suggest that it cannot go any further below this, but it cannot equally find strength to rise. And we have in this a lot of questions to be answered. My first question as a trader, looking long term, would be what are risk trends doing in terms of the currency world? And if we're looking at the risk in the European zone, the Eurozone is currently under a lot of fear because of the migrant crisis. And we've had the Greek issue in July, August resurging, and then we had the Greek referendum. And then we had the quantitative easing from the central bank, and there's another rate decision at the end of the year in December, and we are expecting an upgrade of the QE program from Draghi. So taking into account that these steps lead all to the same conclusion, which is that the euro has been devaluing, and we've come to an area here of consolidation or stall, and we do need a resolution. So this tells me that risk trends may have halted in the wake of the troubles in Europe, and we certainly, the markets need a resolution one way or the other. So this situation, which has gone on pretty much the entire year, if you count the bars, needs to be resolved. Now, looking back, we can see that the situation has not taken us to these lows of 2007, but we certainly recovered almost all of this rise. So the retracement is almost 100%. This is 67.50, for example. So we're only about 250 pips or so from that point. The barrier at the moment is the 0.70 level, but we're not far from these historic lows. You have to go quite a lot further back to 2000 to get to the 50s, 0.57, 0.58. So essentially, we are at a point where some people might say historically this is beginning to look quite oversold. And of course, you might disagree and say, well, look at what happened to the Australian dollar, for example. The Aussie USD has gone further and further down at times when the markets thought it couldn't go further in that direction. So we have to be careful of the fact that currency and their behavior in a relative term of being overbought or oversold may not always be the case. If we stuck an RSI here, it might give us an indication that this might be oversold, but then it might continue further. So that there is really no telling, depending on your strategy. You may want to continue selling this in the medium term. So at some point we'll see a sign of a true correction, but from this point, 2013, Okay, so for the last 2 years, really, we've not really had, we've had a pullback, but we've not had a correction of the downtrend. So the overall downtrend, long term, remains bearish. Going on to our second instrument, which is part of a different world because this relates to stocks. And we have the Footsie 100 index in front of us, which really shows long term something quite different from what we see short term. Short term from August, so from the summer, we had in on Black Monday, which is not the Black Monday of the 1980s. It's the Chinese market basically shook the world with a crash, and this is responsible for the similar formation that you see in the S&P 500 and other indexes. But from this low here of 5,800, so we broke the 6,000 for the first time in a very, very long time indeed. If you look back, so all this 2014, nothing broke the 6,000 until this day. And then, almost by magic, it went back above 6,000 and even up touching 6,500. So it recuperated about 500 pips. And then we are now at a point where it's not managed to break down below 6,000 again. It came close here on the 16th of November. And then it sort of tried to pull back up. But really, without looking at volume for this, it's really hard to tell the strength and momentum of these moves. But I would say that probably without any shadow of a doubt, the short term here does not really give us a picture of risk trends. The risk globally, having been through the exposure to China and having been through the realization that Chinese growth actually had been severely overestimated, having been through the conclusion that markets are indeed overstretched on at several levels, not just the S&P and US equities, also here the FTSE 100 in the UK. And so the stocks for the various companies may be individually on the rise still, and there may be a lot of success stories when we look at release of data for individual companies, earnings for Apple, earnings for stocks individually, but the indexes tell a story. The risk trends are curtailed at the moment because the long-term investors are coming to a point where the market is struggling to find the fuel to take this further. Now, to really make it absolutely obvious, I want to really have this in front of us, which is the long-term monthly chart for the UK or the FTSE 100. And I've covered this many times before, but so I just briefly mention this, that in terms of risk trends, you can see the cycles of uptrend, investment, euphoria, excessive greed, leading to selling, panic, fear, crash, and then basically a rinse out of all the sort of bad debt. And then the cycle starts again, tentative start, euphoria, and so on. So we've come to the third hump. So the second cycle basically ended with the 2008 global financial crisis. And then in sort of April 2009, we started climb again. And this climb has been actually quite long. So if you measured all these, you could say that this rise was 43 months. This one was, just getting rough figures here, 52 months. And this one was 71 months, okay, 74 months. So the cycle obviously doesn't go in a straight line. So if you just measured it from the bottom to the peak of each, and then the bottom to the peak of each wave, that will give you a much longer result in terms of periods. What interests me, though, it's not the exact measure of these, is the fact that they've all basically come back down to these levels, 3,500, 4,000, this zone here. And unlike the S&P 500, the Footsie 100 has not only maintained the shape at the bottom, it's also maintained the shape at the top, in that here we've got the sort of 7,000 roughly, here it's a sort of 6,750, and this was 7,100. So, you know, we are quite close to each other in terms of peaks. And the fact that we've had all this consolidation throughout 2014 means that we're really, the fact that this has not broken back above these levels means that there is no conviction of any kind, and that the risk trends, so the risk on, meaning investment in risky assets, trying to get a lot of money for a lot of returns for investment, but having to bid higher and higher. So we get to these levels, historically, everybody knows that they're running on thin ice. So by everybody, I mean people who have the power to invest significant money that might actually even move these markets. But we certainly, as retail traders like myself, we're not necessarily a sort of buy and hold investor of that kind over 6 years. But certainly, even on a shorter term, even for several months at a time, this has been stalling, not really making much progress. So even looking at just 1 year, you can see that it's not really given us a picture of a market that is hungry for progress higher. And after this rinse out during the Chinese crash in August, you know, there's not really been an opportunity for investors to get back in and push this further high. So it's really a chart like this that tells a story of what happens when the risk appetite is curtailed. Now, I'm not an expert on precious metals, but certainly gold has been quite erratic, and the fact that gold has not taken back the crown as um, the safe haven of choice in times of trouble as it used to be means that what that what that situation suggests is that the US dollar, is now the safe haven. With the appeal of a rate rise coming, that will be where we are in terms of the means of choice for returns and yield and a safe haven at the same time. So the US dollar is really what's driving these markets, and that's when we look at the pound Kiwi, for example. We see the influence of the Kiwi dollar and the fact that the Kiwi dollar has been pushed lower by the rise of the US dollar. Now, the US dollar has been hugely overpriced in terms of, or sorry, rather, is being priced in terms of its appreciation. So it is struggling now to get above that 12,200. But certainly, it's not going to suddenly crash because it is poised for the next move higher, which will come when the Fed will make its move. So the pound Kiwi has been an extraordinary pair, and certainly this is not really a risk-on pair, and this is linked to the Kiwi, which again is linked to commodities. So when we have this portfolio with an equities index like the Footsie 100, a euro-based currency pair, the euro-pound, and then the pound Kiwi, which is tied to the Kiwi, which is tied to the dollar, which is tied to interest rate expectations, and the commodity currency that's the Kiwi, which is tied to dairy exports to China. You can see that there's quite a diversification here in this particular portfolio, and that kind of explores different aspects of risk, because when the pound Kiwi responds to the pound being hawkish, it rises. When it responds to the Kiwi and its troubles with the commodity that is dairy products, it rises. So this long-term trend is a safe trend away from the euro theme and away from the risk trends theme. When it comes to the euro pound, the fact that we're exposed to the pound here and the pound in the pound Kiwi is not the same thing, because they respond to different things. Although they both have the name pounds in them, one responds to the Kiwi and one responds to the pound mostly and the euro. So they are actually behaving in slightly different ways. So just to summarize, today we covered risk trends in the context of these markets and trying to really always keep an eye on the longer term charts and really seeing what the appetite is in the market. I hope you enjoyed the video, and I'll see you in the next video. Thank you.